Hello, everyone. Welcome to Real Talk Office Hours for this Monday, May 4. Presented to you by Startup Grind, Grand Rapids. And Startup Grind is the world's largest startup community. We have over 600 chapters in over 125 countries with a mission to educate, inspire, and connect. We do operate on three values. That's make friends, not contacts, help others before you help yourself, and give before you take. And it was in that light that one of our community members, George Katsanos, came and asked me if I thought it'd be valuable and if I'd be interested in hosting an update on global markets and an expert roundtable where entrepreneurs and leaders could come and ask for actionable advice. As we spoke, we agreed that the fact is the majority of entrepreneurs today didn't have to lead through the Great Recession. They weren't CEOs in the 80s or the 90s. And so how are they to be expected to do anything but follow their guts or the reactionary examples of their peers? In a world of alternative facts and fake news, we need to be informed, rational, analytical, and rigorous in our thinking. The pandemic has been and will continue to be the great global leveler. We invite you to join us live every Monday, Friday, and Wednesday at 12 p.m. Eastern Time as we track the intersection of facts, bias, and action through the analysis of global markets, followed by actionable advice given to entrepreneurs desperate for advice as they do their very best for their businesses, families, and teams. If you missed the live events, you can catch us on YouTube. You can view the recordings at startupgrind.com/grand-rapids. And then we're also now available on Spotify and Apple Podcasts. Before we get started and before I introduce George, a little bit of housekeeping. Comments made and views expressed by all participants in this podcast are not intended to invite or incite individuals, entrepreneurs, or investors to buy or sell financial assets, real assets, commodities, futures, and or options. The purpose of this podcast is to educate and to inform, not to trade or to invest. If you feel compelled to trade or invest, please call your broker. And with that, I would like to introduce our presentation by George Katsanos.
Thank you, Corey. Good afternoon, everyone, and thank you for joining us for one session of Real Talk. I would like you to have a look at the two cartoons that Cal has printed in The Economist. On the very top one, we see that some sea animal called debt is extending a tentacle to the world economy as a lifeline, hoping that we'll survive. But this world economy is barely beginning to budge from the depths of the economic calamity. The second caption that Cal very astutely prepared is about the US economy, that essentially strong stimulus packages are unlikely to have an immediate effect in terms of opening up, in terms of rebooting the economy, and so on and so forth. So what Cal is capturing here is the fear that the world economy will not mend immediately, and that the US economy will take time to recover going forward. With this in the background, I would like to start by looking at our asset classes. Every Monday, Wednesday, and Friday, Corey and I go through the financial markets, starting from foreign exchange. They will move to bonds, equities, and commodities. The reason we follow this methodology is because we believe that public markets, with all the limitations, give us information and nuggets of either advice or warning about outcomes that affect our lives. What we're trying to do in this Monday, Wednesday, and Friday event is to parse information from the financial markets as we gauge them with our experience and share this information with our participants and the broader Startup Grind community. Foreign exchange is historically a very important indicator about trends in the world economy. we see in today's um, capture from Bloomberg. I hope you can see these currencies. These are currency pairs, as we call them. The first one is euro dollar. The second is dollar yen. The third is sterling against the dollar. The fourth is the Australian dollar against the US dollar. And the fifth is the US dollar against the Canadian dollar, followed by the exchange rate between the United States dollar and the Swiss franc, and euro and the yen. When a currency strengthens, it means that its interest rate and the outlook for the currency is positive, but it also means that some form of uncertainty is beginning to emerge. What do I mean by that? The reason the dollar has strengthened over the last couple of years is very simple. Here I have this chart. On the left-hand side, you see the dollar-euro exchange rate. This is on a daily basis, but I will change it to a weekly basis. You will see that back on the 12th of February in 2018, the dollar-euro exchange rate was 1.25. So that meant that $1.25 would buy 1 euro. At that time, the dollar was deemed to be weak. On the 23rd of March of 2020, the dollar-euro exchange rate was 1.06. In other words, $1.06, $1.06 would buy 1 euro. So within a space of about 2 years, we moved by the equivalent of 19 cents. In other words, the dollar strengthened against the euro by 19 cents. This is a relatively big move, and it is explained to a considerable extent by two major factors. One was the interest rate differential, meaning that if you're an international investor and you're investing in a bond that has an interest rate of X, you will prefer that bond if that bond has an interest rate that is higher than other relevant bonds. And if you remember, the US interest rates have been higher, and the US government bonds were higher in yield terms than European. And we explained that last week when we compared the yields on the 10-year bonds. We will do that again today. So the first reason why a currency becomes stronger is because foreign investors want to invest in that currency's bonds because they find them attractive due to interest rate differentials in relative terms. The second reason, and this is a big significant factor in investor determinations as to where they invest, is safe haven. At times of crisis, dollar has been a safe haven for international investors from everywhere on the planet, whether it is emerging markets in Latin America, Africa, Asia, or anywhere in the world. And the reason is because historically the Federal Reserve has been a leader in assisting world economic recovery. And the management of disequilibria, dislocations, has been successful and has been helped by the Federal Reserve. So international investors, as we speak, are investing in dollars against euro. You can see that the dollar today is stronger against the euro, the yen, the British pound, and Australian dollar, the Canadian dollar, and so on and so forth. When we look at the bonds, as we have discussed in previous events, the 10-year bonds have not moved dramatically. Once investors anchored there are concerns about economic growth in 2020 and beyond, we have seen that bonds have been an investment of safe haven for many investors. These are bonds issued by governments, and as you can see, and as we highlighted, the lowest level today is Germany and Switzerland, with 10-year yields of negative 0.6%. That means investors are willing to pay the governments to hold 10-year bonds. These investors are clearly risk averse, and they're concerned about the return of their capital. In Asia, Japan is leading the way, has a mildly negative yield, 0.04%. But when we look at Australia, New Zealand, Hong Kong, and Singapore, we see also that the 10-year bonds issued by these countries are below 1%. So in other words, as investors are investing in these sovereign issuers, these governments, they will be getting less than 1% per annum for 10 years. In the United States, Canada and the US are nearby in terms of the yield of the 10-year bonds. The US has a yield of 0.6% and Canada 0.55. Mexico, on the other hand, has a yield of 6.5%. So generally speaking, again, bonds are considered to be safer investments than equities, and that's why investors tend to invest in bonds. Let's look at what's happening in the global stock markets. Last week, the first half of the week, all the way till Wednesday, when we had the Federal Reserve meeting and the announcement of the Federal Open Market Committee decisions, the market had a positive trajectory to be reversed in the next 2 days, on Thursday and Friday. Today, the markets are globally mixed. We saw that most of Asia was in the red, with Nikkei tumbling 2.8%. Tokyo Topix Index was down 2.2%. Hang Seng in Hong Kong was down 4%. And generally, the Morgan Stanley Index covering Asia Pacific was down 1.8% today at market's close. Europe, on the other hand, has just closed, and we see that Europe is also in the red across the board, from the lowest 4.2% in France, negative 4.2%, 3.6% down was Spain, and the DAX was also down 3.6%. The Financial Times Stock Exchange Index in the UK was just down 0.16%. In the US, as we speak, the markets are relatively mixed. The Nasdaq is up 0.4%. The S&P 500 is down 0.4%. The Dow Jones is down 0.75%. Lastly, I would like to have a quick look on the commodities section of the markets. And the reason for that is because we should see what is happening in commodities that affect our lives. First of all, oil. West Texas Intermediate, the oil that the US produces, is up close to $20. That is a significant recovery from last Monday's close of $13. We also see that natural gas is higher. It's about $2 per million BTUs. Gold has recovered, is trading 1712. Clearly, this discussion about new potential challenges in the relationship between the United States and China is making investors be concerned. That has an effect on oil prices. Also gold, investors are clearly concerned that too much printing of money, the monetization of the debt, in other words, could have inflationary challenges in the months ahead. On the agricultural side, we see that corn is at $314 per bushel, wheat is $516 a bushel, and live cattle is at $87.70 per pound. The corn is down 1%, wheat is flat, and live cattle is up 0.5%. As we're heading into the growing season in the commodities, it's worthwhile paying attention to these prices because commodities are sensitive to global trade policy and, of course, either tariffs or sanctions or disagreements. I would like to focus for a moment on some news we have been reading more recently, and particularly about the headline announcements. First of all, over the weekend, we saw that the Warren Buffett and Berkshire Hathaway had their annual meeting with no direct participants because of social distancing. The company announced a loss of nearly $50 billion in the quarter. The total elimination of airline shares from the portfolio, and the fact that the company is sitting on $137 billion in cash. What is interesting is that the private sector is beginning to compete with the public sector. As Mr. Buffett made abundantly clear, had the Federal Reserve not intervened in financial markets, it would have been easier for Berkshire to find targets to use its capital. This is an issue that we highlighted in previous occasions, namely the importance of bailouts and the moral hazard implicit in these bailouts. Would it have been perhaps better for the private sector to determine who is who in the zoo, to determine winners, losers, as opposed to the government? But this is a debate that will continue for a long time. An important event this morning in news announcement was vehicle sales. April vehicle sales decreased to 8.6 billion in April, the lowest level in 50 years. Expect a lot of help cries from Detroit. Next bullet point that is worth paying attention to is that Apple is now willing to borrow again in bonds maturing 3 years, 5 years, 10 years, and 30 years, and intends to use these funds to pay for the newly announced $50 billion stock buyback. So what we have here is companies borrowing from the debt markets at unheard of low interest rates to fund share buybacks. That, I'm sure, will raise a lot of questions in the future. Last but not least, I would like to have a few words about the emerging markets. As The Economist is highlighting in this week's issue, emerging markets are in a financially difficult position. And the reason they're in financial difficult position is because they actually have several challenges ahead of them. One of the challenges is related to their deficits. In particular, their efforts to support their economies. The second big challenge they have is the ability to service their external debt. And the next level of challenge for the emerging markets is the cost of these borrowings. In other words, as we're heading into this prolonged slowdown, which will have impacts across the board in our economies, some emerging markets will experience more problems being able to pay their public debt, manage their public and private foreign debt, and meet the foreign payments. And rest assured, this is going to be a major challenge going forward for all of us, because this dislocation in the emerging markets is going to reverberate through our markets as well. I would like to conclude today's part of the presentation here by highlighting that the markets will all public financial markets will always give us information depending on how we analyze them. Under every crisis, there is a silver lining. We should be looking for the silver lining. We should be looking for positive outcomes, notwithstanding the crisis. And we should always ask experts to be able to contribute with their knowledge and expertise to answering these riddles. Because underneath these riddles, or inside these riddles, there's always a golden nugget. Thank you, Corey.
Thanks a lot, George. As we move through these presentations, I think there's certainly a real value when we get to the part where we can help our entrepreneurs understand, what it means for them, on their main street, right? And with what you were just talking about as far as silver lining, we continue to see the markets from very broad view, maybe being very optimistic, and what might be some guidance for the entrepreneur, say in a startup or in a business that just got started, as they're listening to the bankers say, hey, everything's going to be great, everything's fine. With the data that we're presenting, what might be some things to look at from what we're pointing out, and how they can try to make make decisions in the next like 6-8 weeks or something like that.
Yes, I agree with you. As we are looking at this week's developments, may I actually make a point that the calendar is getting quite busy. Can you see tomorrow's calendar? These are major announcements around the globe, right?
Yep.
The central bank at midnight tonight is going to essentially announce its decisions on interest rates. Tomorrow we have Switzerland's CPI, the inflation indicator, but we also have Spanish unemployment. Then we have in England the final services purchasing management index. We have the European PPI on a month-to-month basis. These are important data. And then we're moving into the trade balance in the US, final services purchasing management index in the US, ISM non-manufacturing PMI, and then we're looking into the economic optimism. Going into Wednesday, the 6th of May, we have essentially services across the board in Europe. We have German factory orders, Spanish services PMI, Italian services PMI, French services PMI, German services PMI, and of course we have construction PMI in the UK with retail sales in Europe. In the US, we have non-farm employment change at 8:15 in the morning, East Coast time, and crude oil inventories at 10:30. These are important pieces of news, and they will be affecting the markets and the signals that the market will give us. So let's keep focused.
Sounds like there's going to be, it sounds like a very busy week for us.
Yes, it will be, and I'm actually looking forward to it because we should be getting more clarity. Positive or negative, that's not really the real issue. The real issue is that we know we are in a very unpredictable environment. Optimism has to be tempered with a good glass of hard realism, and we have to take it day by day because this is a major global pandemic. We're not aware, we're not sure yet about its full effects. I bow to the expertise of CEOs of publicly quoted companies. As we discussed, these CEOs are refusing to make any pronouncements about the future. And more important than that, they are very conservative. So let's keep our head above the water and let's study the markets and see what we can understand from these movements.
Great. I did have one question for you, George. As I was coming into town today, I heard from someone presenting from the Center for Economic Policy and Research. They were speaking about like the U.S. unemployment numbers, and they were also suggesting from a recent survey that because of the challenges that people are having in getting their unemployment benefits, that the real unemployment numbers could be far greater than we're thinking right now. Like what might that mean to to our entrepreneurs as they're looking for talent, or as they are trying to like decide what to do in these next weeks?
First of all, let me start by reminding us of a statement by Enzo Ferrari, the founder of Ferrari. Many years ago, this icon of industry, great innovator, great manager, he said that the cemeteries of this world are filled with individuals who used to be irreplaceable. So no one's irreplaceable. That's the first thing. The second thing is that we should be looking at skills and people who want to work. The market will be available for laborers of lots of different types, young, old, experienced, inexperienced. I think that means that we are likely to have relatively large supply of individuals looking for jobs. If unemployment rises above current levels, then we will see a number of effects that we also saw into the crisis of 2008, 2009. The number of people who will leave the employment sector willingly will increase. They will exit, in other words, the labor force, and they will not come back, especially those in towards the end of their own perceived economic cycle. People in the 60s and 70s, if they're still working, they may decide not to come back into the labor force. Most other cohorts, however, will be looking for jobs wherever they can find them. When you look into LinkedIn and other such websites, you realize that to be looking for a job with any qualification is no longer frowned upon. People understand that this pandemic led to closure of significant businesses and will continue to do so for some time. So for entrepreneurs, what I would suggest is interview, and give people a chance. The pandemic has been a great leveler, and we should try to be optimistic. We should try to help our communities and the people around us.
Awesome. I have one last question for you, and then we can wrap up here. I was reading a bit about the announcements from a lot of universities, more and more now, that are talking about opening in the fall, specifically for their freshman classes. And a lot of our audience are students in business, students in finance, students in marketing, and many of them are eager to return to campus. Are we thinking that this is when we have universities of the pedigree of like Baylor saying yes, we're going to have classes in fall? Are we looking at that being a viable opportunity for students that are beginning their college career this coming fall?
Corey, this question is at the core of the dilemmas all of us face on a daily basis. To participate or not to participate. In other words, do we go back in an active economic life or not? And if we decide, yes, we want to be economically active again, then what are the qualifications? What are the requirements that we have so that we can protect ourselves and our families? There's supply and demand of education. The supply comes from colleges, universities, and other academic institutions, and the demand comes from students of all ages, including continuing education. The big question is, how are these institutions of tertiary education going to accommodate social distancing? Even if we do get a vaccine, we know that coming November, December of 2020, we may well have a second wave of this crisis, this health crisis. But as you know, by that time, we already have the flu crisis. So our health sector is going to be probably overwhelmed. Is it wise for higher education and tertiary education to be inviting these young freshmen into close quarters without enough data that justify policy decisions? That's one question. The second question, if you're a parent and you actually have a son or a daughter who is going to be a student in any university, how will you make sure that this young man and young girl come back home safe at Christmas?
Yeah, that's it's a lot to think about, especially as things change so fast. So I think that's why I was curious, because reading such announcements just sounded a little interesting to me. So thank you very much. With that, I want to implore everyone to lean into their curiosity and find the best facts they can find as they navigate this pandemic for their businesses, teams, and families. And George, if you have any last words before we sign off.
Two things. Never let a crisis go wasted. There's a silver lining. Second, past performance is not a good indicator for future performance. Thank you very much, everyone. See you on Wednesday.